Welcome back. And just to remind you, monetizing debt, that's what you do when you really don't have the money. You've heard the talk of the $1 trillion coin. Well, Ben Bernanke monetizes the debt. He creates fiat paper money called Federal Reserve notes and uses it to buy U.S. debt. That is monetizing the debt. That's like having a printing press in your basement, and when the bills come, you just print you up some money. But there is some money you cannot print, and that is silver and gold. And for that, we've got David Morgan. David, how you doing, buddy?
Doing well, Alan. Thank you.
How are things out there in the Pacific Northwest?
Well, we got a little snow the last week or so, and it's pretty white out here.
Well, it snowed here once or twice.
Okay.
Yeah, not that often. David, let me ask you a question. Why is the dollar getting crushed today?
Well, the daily basis, you really don't know. I mean, there's lots of individuals and institutions primarily selling the dollar for whatever the reason being. I think from a general perspective, it's that the fiscal cliff was basically swept under the carpet again, no real reform. They keep passing these laws. I mean, people have asked me, what about balancing the budget? Why don't we pass a law? Well, look at Graham Rudman. I mean, that was exactly what that bill was purported to do, was to put a debt ceiling in place. You couldn't go over it, and you had to balance the budget. Well, look what's happened year after year after year, quarter after quarter. The Fed continues to increase the budget the debt limit. Budgets keep increasing, and we go further into debt. And as I've said, almost like a broken record, you can't solve a massive debt problem by adding to the debt. That's exactly what politicians and governments are doing around the world. And these things do not end well. They just simply do not.
David, you raised a couple of good points. First of all, on Graham Rudman, that's where we got the term sequestration. But Graham Rudman really went out the window when we needed to go invade Iraq. And then my next question would be, we see silver is having a very good day. Silver's up, about 1.4%. Gold's up 1.2%, which is what you would expect when the dollar is getting ripped apart like it is. Is this a good time to be adding to positions in silver and gold, physical silver and gold, if you already own the metals?
I think it is. I mean, I've been pretty consistent here, Alan, and said any time you get under 30, it's an excellent buy for silver, and anything under probably the 1650 level for gold is an excellent opportunity as well. We're above those levels as we speak, but you can't really look at it penny for penny. You want to give some general, advice, and I would say that at this area, of course, it's a good buy. And looking back, if you're going to pay $30.60 or 70 cents versus $30 when silver at some point reaches past 100, and I believe strongly that it will, then did you really save much money by, not getting in because you were going to, save 60 cents? So you have to put these things in perspective. As far as leverage positions, though, I'm holding off. The market still is wishy-washy. One day doesn't make a market up or down. But what I find profoundly interesting is after the QE4 announcement, basically that's been the high for the metals for the last couple of months. And I find that interesting that you would see a sell-off, so to speak, after the Fed basically announced that it's QE to infinity. They really are not saying there's a limit on anything. They're targeting the unemployment rate. So the real repercussions of the market longer term are profoundly destructive to all currencies. And because of that fact, you would expect gold and silver to react the other way, meaning they'd be higher after that announcement instead of lower.
David, I know you follow monetary policy, the money supply, and things like that. Could it be safe to argue that we are actually in a deflationary period that is being masked by massive amounts of money printing?
True. It's really a stagflation. What we really have is a credit contraction, which is the basis of a debt monetary system. It has to expand. If it doesn't expand, it'll start to contract. So you do have contraction basically across the board. It's very difficult to get a home loan now. Most loans that you go to a bank to get, be it a business loan or some type of equity loan, are difficult, whereas a few years back before the 2008 crash, you could basically be breathing and you could get a loan. So there is a credit contraction, as you said, Alan. To counter that, the Federal Reserve has had a very, very loose monetary policy. But all that's really done is reliquefied the banks. The banks haven't really put that money out in any substantive way out into the public domain, meaning either through businesses or personal loans or equity loans. And so that money's just sitting there. So it's basically as if it's stagnant right now or has no real meaning. But I think that will change, and it doesn't even have to be by more lending, although that would certainly help the velocity of money. It basically is the amount of money that's still out there floating around looking for, seeking a home to catch fire or a flashpoint, as I wrote about in the Morgan Report in this latest issue. At some point, the consciousness will change, and there'll be an event, and you can't ever pinpoint it to really one, although at times you might be able to make that case. Regardless, what you'll find is the money velocity starts to pick up, and then that's pretty much unstopping. So, the old adage, you better be careful what you wish for. If Ben Bernanke wants to see some, good inflation come on board, he may get his wish eventually. I'm almost certain that he will. And once that starts, it may be much harder to put out than he thinks.
David, you threw out two terms that I did want to elaborate on. First of all, debt-based monetary system. Again, what we circulate for money, what we circulate as money is actually the U.S. debt. So that 20, I hate to call them dollars because they're not, that Federal Reserve note with the number 20 on there, that is 20 worth of U.S. debt. So that's a debt-based monetary system. No debt, no money. You literally cannot pay the debt off because then there would be no money. So as the debt of this country increases, the money supply increases. That is a debt-based monetary system. It was a scam first perpetrated. Really got underway well with the Bank of England in 1642. The second thing that David mentioned was the velocity of the money, and that is the rate at which it is changing hands throughout the economy. And as the, what do they call that, the M3 velocity indicator, something like that, as it begins to circulate more rapidly through the economy, then this 35% increase in the money supply we've seen since the bailout era began, that ignites the inflation. David, so let's say you're currently sitting on a position in gold and silver. Do you add in here?
You could add slightly, surely, and I would be cautious. And if you're going to add physically, that's fine. Just keep accumulating there. So if you're going to add any positions, leverage-wise, meaning ETFs, futures, options, anything along those lines, I think you're safe in here. But safe doesn't mean I'm right. I would definitely have a pretty tight stop to it. I don't think we're going to see. I think the worst is behind us, but the market's no more than any of us. And as far as describing the 20 unit, I like to call it the Federal Reserve accounting unit denomination. That pretty much describes what it really is.
Well, it's tough to call them dollars when they are, in fact, not dollars. They're just Federal Reserve notes with the number 20 on them.
Exactly, a Federal Reserve accounting unit denomination. I mean, this is just an accounting fraud, really, that's taking place, and yet most people are way asleep. They don't understand the monetary system. They think it's too complex, and so they are happy to have someone else take control of it. And unfortunately, enough of we the people will have to basically take matters in our own hands, and that's the problem that these bankers have, is that there's enough physical demand for gold and silver. It's such a precious metal, both of them, and it's in such small amounts relative to the paper supply that at some point I think there's going to be a real comeuppance. But the unfortunate thing for me and people like me is saying when, and none of us know when. But I don't think we have much more to go. I'm guessing, probably in the next couple of years. I think 2013 will be a watershed year. You'll see the test of the $1,900 level in gold a couple times. It'll probably get through it. I'm almost certain it will. And you'll see the $2,000 to $2,200 level for gold by the end of the year, perhaps more.
David, we got to go. This is David Morgan. You can Google him, the Morgan Report. David, it's always a pleasure, buddy.
Thank you, Alan.
We'll be back on the other side of the breaks.
Last night in the rock, put me in a haze.